So we've had this negative trend in house prices since, of course, this peak we talked about in March, and barely any growth in home prices in November. What's primarily driving the negative trend?
Well, firstly, it's not a very well. It's in the boom times there was an overshoot. So for a couple of years now, it hasn't been a very appropriately priced market. It's been an overvalued market, I guess you could say. So as soon as there's a lack of any economic or interest rate stimulus, price growth very easily tends to go back towards low single-digit figures. We had some nice economic growth earlier in the year, and I think that spurred something of a little minor improvement. Certainly, a lot of agents that I've spoken to seem to have felt a lot better for some months now about conditions in the industry. But I think the main improvements were earlier this year, and at one stage the growth in the house price index earlier this year reached 8%. But now there's a lack of new stimulus to boost it to even higher levels. The economic growth is certainly has slowed down, 1.2% growth in the third quarter. And yes, I think it's a reflection of economic times, and we've come down from that 8% earlier this year down to 0.5.
It certainly isn't encouraging. Let's talk about the actual nominal value, the average value of homes transacted according to the house price index, around 820,000 in November. How does that compare to previous years, say this time last year or perhaps 2 years back or closer to the boom times?
Well, very similar. I mean, that average price was 0.5% up. Do the maths. It's not in your head. It's not very much up. It's about 7% up in nominal terms since the real price peak, which was early February 2008. But in real terms, if you adjust for CPI inflation, real prices are down by about 18%. Go back to before the boom, and you're talking about, 213% up the index. So still, in real terms, nominal terms, either way you want to look at it, since the beginning of last decade, still significantly higher, but since 2008, not much growth at all.
So what does this mean for those who are looking to invest in property right now? If you're looking at inflation, which is above the house price growth, does this dilute the argument that property is a fantastic store of wealth?
Well, I don't think one should ever see property as always keeping its value. A lot of your downward, it really goes through national nominal price declines. Economic conditions have to get quite bad for that. They did in the 80s and they did in 2008. But normally corrections happen over a long period in real terms, where nominal price growth for lengthy periods does underperform CPI inflation, and so you get those corrections. But in real terms, you do get downward corrections. It's not always a storer of real value. But for investors, for the seasoned investor, that's not that important. Stock markets, property markets, whatever, values rise and real values fall. What's more important is yield. I don't think as yet, my perception is that residential yields on average aren't that attractive yet. There's still some years to go. And what's needed is for a few years for the rental market to outperform house price growth. That's the way to a more attractive investment. For those hoping for sharp house price growth at the moment, that's not a wonderful thing for investment at the moment. Yields need to rise. They are, as I say, my perception is residential yields are a bit on the low side to make it attractive still.
So what is going to drive ultimately that rise in yields?
Well, ultimately it would be an economic story. Well, I beg your pardon, the rise in yields, stronger capital growth would be an economic story. There would have to be a much better performing economy, which I think is a good few years away. For yields to rise, actually low price growth for some years, which I think is on the cards, a stronger rental market as time goes by, stronger rental inflation, and so your income yields should rise. It's a gradual process. I think it's a few years away from where we've got really attractive yields for residential property, but that's really from this more seasoned investor's point of view, that's probably what they would like to see happen in the next few years, I would guess.
From the market perspective right now and where we're at right now, we saw the 0.5% growth for the month of November, certainly tapering off, as I said, from March's 8.4% growth. Do you think the market is realistically priced yet? Do you think it's perhaps still even, we could look at it being undersupplied at any time soon? Or what are your thoughts on the outlook on those two fronts?
I don't think it's entirely realistically priced yet. Now, this is a very subjective thing, but in my subjective opinion, average time on the market for the country as a whole, in a solid, well-balanced market, probably 2 months, I would think. That's what it was before things really went south in 2008. We're currently up at 15 weeks and 6 days, which is nearer to 4 months average time on the market before being sold, according to our third quarter estate agent survey. And so I think there's some way to go before that average time has come down. How would it come down? Well, by increase in pricing realism, which I think over the next few years would almost, I wouldn't say necessitate, but probably lead to further real house price decline.
Given you saying that, then what's the outlook for 2013? What type of growth might one expect from home prices in next year?
Well, I'm assuming some sort of slow positive economic growth, and under those conditions we're projecting average of 4% price growth. Now, it's not an exact science, but basically what I'm trying to say is that for next year as a whole, I expect nominal house price growth to underperform CPI inflation, which we expect to be nearer to 6%. That means a real decline. And yes, that's just one step further to the sort of price in the price correction process, which has been happening, broadly speaking, since 2008.